At the beginning of this year, China seemed to be making its way toward economic recovery, after being subjected to a series of crises, at the forefront of which were the property and banking sectors stumbling. It seemed as though things were finally taking a turn for the better. Several analysts predicted that with COVID restrictions lifted all over the country, China's financial troubles would end. Naturally, this prediction extended to the banking sector as well. Unfortunately, after a spike of activity, things have fallen back down into a stagnant slump. And the question remains, what happens next? For today's video, using the banking crisis in China as a starting point, we're going to dive to the bottom of a whole plethora of issues, including China's property crisis, increasing debt, and severe unemployment crisis. First, let's talk about the Chinese banks. In July 2022, protests broke out in the Henan province in central China. The trouble all began in April 2022, when customers of the new Oriental Country Bank of Kaifeng, Yuzhou, Xinminxing Village Bank, Shanghai Human County Bank, and Zhengzhou Huanghuai Community Bank were notified that they could no longer withdraw money from their accounts. What was truly strange about these notifications was that they had seemingly come out of the blue. No matter who they spoke to or what authority the account holders turned to, they weren't given a clear-cut answer as to why their accounts had been frozen. Although they couldn't possibly have known this back then, this incident was reminiscent of new and emerging catastrophic trends in China's economy. What was once considered to be one of the most reliable economies in the world had revealed itself, if on a small and local scale, to be prone to fluctuations and trouble. The issuance of the notification led to a massive bank run where account holders demanded answers. Most people wanted to withdraw their money and savings, but were consistently refused. After weeks of being unable to withdraw their funds, account holders all over Henan began to fight back, and protests broke out. Before these protests could come to a head, they were duly shut down by authorities, who then proceeded to make the audacious claim that they were carried out by criminal gangs. Despite all the ruckus that had been caused, account holders still did not get the answers that they searched for. A year later, the incident in Henan seems to be treated by the Chinese authorities as an isolated incident, not worthy of further contemplation. As far as the authorities are concerned, what happened in Henan was not symbolic of an economic collapse, as several analysts and economists predicted, but rather the foolishness of a few small regional banks. As isolated as the Henan incident may appear on the surface, it is definitely worth exploring in the context of the greater economic landscape. China's banks, the epicenter of crises and trouble. In order to understand why the sight of banks running out of funds is such a troubling sight in China, we need to dive into the deep, deep trouble that the property sector is in China. By some estimates, the property sector amounts to 30% of all economic activity in China and 75% of all household wealth. These statistics are not meant to scare you. Rather, we're relying on them to demonstrate just how dependent China's economic well-being is on property. For the longest time, property developers relied on China's economic policies favoring them, along with what then seemed to be a perpetually high demand for accommodation in the city. As the waves of rapid urbanization spread all throughout China, an increasing number of people fled to cities looking for a place to live. This created an unbelievably high demand for property, which led to Chinese cities having the highest home prices to income ratio in the world. For Chinese property developers such as Evergrande, this meant a hole of money. Over the course of the past 2 years, however, China has been thrust headfirst into a severe debt crisis, perpetuated by the property sector. Interesting to note is the fact that this crisis was created out of the government's need to control and rein in the spiraling debt burdens through the introduction of the infamous 3 red lines. To simplify an extremely complex topic, with the introduction of the 3 red lines, developers were required to meet certain criteria before banks could provide them with the loans that they required. Before the implementation of these notorious policies, the property development sector in China was completely reliant on loans to finance its massive projects. As you can imagine, these new policies rendered the old way of building apartment complexes in Chinese cities completely obsolete. And how did property developers deal with this new change? The short answer is quite poorly. Massive companies such as Evergrande were defaulting on payments and struggling to sell apartments and raise funds. As these companies stumbled, several projects were abandoned, simply because companies no longer had the funds to complete them. A prime example of this is China's infamous ghost city, Ordos, which bears testament to a property sector in complete shambles. Despite local governments rolling out hundreds of measures to support the property sector, positive investment in the sector remains short-lived. However, a rather devastating effect of the three red lines is that house sales and prices have declined, and several homeowners have refused to pay mortgages, which further exacerbates the crisis. But what does the property crisis entail for Chinese banks? Contrary to what you might think, looking at China's stumbling economy from a macro perspective, you start to see that banks are at the center of the entire fiasco. With the property market failing, banks, especially smaller banks with riskier lending practices, are at a high risk of collapsing. Much like the regional banks in Henan, larger banks all over China lend mortgages to homeowners and loans to property developers. With customers refusing to pay their mortgages and property development companies defaulting on their payments, there's been a rapid decrease in the amount of funds that banks have at their disposal. Just to put things into perspective, according to some estimates, homeowners refusing to pay mortgages resulted in the banks accumulating a massive $83 billion. Although it may sound like an over-exaggeration, with the introduction of the three red lines, banks were basically thrust out into the vast space of the unknown, with no tools or guidelines on how to navigate this scary place. And although the banking crisis hasn't yet exploded into a fully fledged crisis on the national level, this could seriously become a problem for China in the future. A falling banking sector combined with the detrimental state that the property market is in, China's meteorically high debt levels, a youth unemployment crisis, and a shrinking population could have disastrous consequences for the country's economy in the long run. COVID and beyond. COVID changed the face of the global economic landscape. Perhaps in the future, the current economic crises that China is undergoing may be seen as a general side effect of a post-pandemic world. But for the longest time, a full recovery from COVID was seen to be the best chance that China had in healing its flailing economy. When the last of the COVID restrictions were lifted from Beijing in December 2022, many experts predicted that China would make a full recovery in the coming year, and the economic landscape would return to its pre-pandemic condition. In March 2023, China's exports rose unexpectedly as demands from most Asian countries and Europe increased. Following this, the nation's factories resumed production, boosting the economy's outlook and indicating global growth could even be better than what was predicted. Unfortunately, this rapid surge of growth was short-lived, and by June of 2023, it became obvious that economic activity had fallen stagnant. For the first time in 10 months, the People's Bank of China reduced its medium-term lending facility from 2.75% to 2.65%, which signifies the dissatisfaction with the present state of the Chinese economy. Additionally, the property sector still remains in disarray, and while housing prices are better than what they were last year, they're still not as high as they were in 2022. China and surprises. So what does it all mean for the future of the Chinese economy? While the present-day situation in China seems to be verging on the brink of collapse, it's quite unlikely that this would actually happen. If there's one thing that we know about the Chinese economy, it's that it's full of surprises, which makes all economic predictions extremely fickle in the long run. Allow us to present you with a couple of examples to demonstrate our point. First, China surprised us earlier this year when its economy underwent rapid growth, higher than what anyone expected. Then, as the first quarter came to an end, the opposite happened. Recovery fell flat, and the country's economy still stumbled and flailed. All the projected figures for retail sales, property sales, and investments fell massively short. And to add to all of that, now more people think that the economic conditions will continue to deteriorate within the second quarter as well. If there's a lesson to take from all of this, it's that China's economy is unpredictable. While it may seem that Chinese banks and property developers are done for, the figures at the end of the second quarter might just surprise us. On that positive note, today's video comes to an end. As always, we'll be reporting how this situation plays out. Thanks for watching. Make sure to keep an eye out for our next video.